One of the key concepts I try to educate investors on is the cyclicality of returns. Nothing goes up or outperforms forever. Eventually, expectations become too great and prices simply get too high. With some notable exceptions, the opposite also tends to be true. Low expectations and widespread pessimism can actually be a great time to invest because those things typically mean that prices are low. So over the last few years, as more investors and even some financial advisors reduced or even abandoned international stocks, we wondered if things might finally be reaching an inflection point. Performance was more mixed this past quarter, but year to date, as shown here with the blue bars, international stocks, both developed and emerging, have more or less doubled up US stocks. It's too early to say if this is the start of a more sustained trend, but it is a great example of the cyclical nature of returns, given that this year represents a material shift from what we've seen in prior years. Of course, whenever we see markets have a big move like international has had this year, the logical question for investors is, have we missed it? Are we too late? The first thing I'll say is that for our investors, no, we didn't miss it. We've never wavered on our allocation to international stocks. For those that haven't been invested internationally, no, we don't think it's too late. Our investors know the first thing we're going to look at is valuations. And despite recent returns, valuations are still very reasonable for international stocks. Looking at forward price to earnings ratios across markets still shows the US, the orange line, significantly above that of Europe and emerging markets, with and without China. International markets still trade at huge discounts. Some of that discount is warranted, but the 40% discount today is one of the largest in history. With recent performance, it'd be logical to assume that that valuation gap would have narrowed a bit this year. But that actually hasn't been the case. International markets may have performed well, but as the bar chart on the right shows, a large part of the outperformance has been currency driven. International markets have done a little bit better when we strip out the currency part, but certainly not enough to close the valuation gap in any meaningful way. What this means to us is if the tide is really turning for international stocks, they could have a lot further to run. Investor sentiment takes time to shift, but there are also some reasons beyond valuations to think the momentum could continue. A softer US dollar is another factor to watch. We've already seen how much currency can impact returns, and while the dollar has already come down quite a bit, history shows it tends to weaken further when the Fed is cutting rates and the economy is growing, which is exactly the scenario we're in today. There are certainly still risks around tariffs, but those risks have been meaningfully scaled back and are much better understood today versus 6 months ago. Looking specifically at Europe, growth has steadied, inflation is near 2%, unemployment is near cycle lows, and monetary policy is accommodative. We're seeing that translate to optimism and fiscal stimulus in a country like Germany, for example. After years of austerity, the government recently removed a debt brake or debt ceiling, which is already leading to new investments in semiconductors, clean energy, manufacturing, and defense. And last, but certainly not least, US investors are woefully underallocated in international markets. Investors tend to chase returns. So with US markets outperforming dating back to the financial crisis, investors over time became increasingly US-centric to the point that many investors have little to no international exposure at all. If international stocks continue to do well though, those same investors will reverse course and create additional demand for international stocks. Investors who wait for more momentum and stronger returns will likely end up mistiming it. But for those already in international markets we're allocating today, we don't think it's too late. Stay with us for our next video where we look closer at what is happening in private markets in a recent effort to make them more accessible to all investors.